This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today.
So I actually want to share this because was such an incredible process for me, and I'm kind of surprised when I share this how many people don't really understand like the velocity of money. And so the quick story here is my first investment was in 4 townhomes. They were short sales at the auction. So I paid $100,000 per townhome, 4 of those. Fast forward a few years, they're worth twice that. So worth $200,000. So I did 4 1031 exchanges from those 4 townhomes into 4 fourplexes, right?
Wow.
So 4 doors to 12 doors. Fast forward 3 years, those fourplexes had about an additional $250,000 of equity appreciation in them. So I sold all 4 of those fourplexes and went into 12 new fourplexes, all through 1031 exchanges. And so I kept doing the same thing. I literally went from 4 doors to, I think it was 64 doors with no additional money out of pocket, purely through using that equity appreciation as the down payment through a 1031 exchange, right? So there's no tax liability along the way, or at least defer the tax liability. And so anyways, an incredible way to scale a portfolio without having to infuse a lot of new money into it as we went down that road. And so that was really how I accomplished that first goal.
Did you property manage? How did you handle that on the side?
No, I've actually never managed any property myself ever in the last
That's a relief.
years.
I just gotta say, I'm like, I don't know how people do it anyway, but to hear you say that, I feel like it makes it more doable for listeners and individuals who might want to set this kind of goal. But go ahead.
I really do. I mean, I think ultimately it just comes down to what is your highest and best use of your time, right? And if some people are more operationally focused, and that's where they get energy and passion, awesome. Feel free to do that. But for me, my highest and best use was to continue, being a leader of men and running all these, these offices across the country and earning, a really good active income, and then being able to just transition that over into real estate. I call it stack and rack, right? So you want to, and I think it's actually even more relevant right now today where we are in real estate, because in the last 12 years, we've had such a tailwind behind us where, you could wholesale or flip properties and do more of the transactional real estate. But I think right now it's more important than ever is, if you can just earn a lot of money, through your day job or active income, and then be able to move that into real estate, it's just a way to get started a lot faster in real estate, right? Versus just kind of trying to, what's the right word? Bootleg it, right? Where you're just not really putting a lot of money into it now, and you're just hoping for that appreciation over, with time. So, but yeah, it's been really fun. Honestly, I'm so grateful for having learned about real estate, when I was 22 years old, because it has created so much freedom for me. And I really do believe it's the best way to create, not only time freedom and financial freedom and lifestyle freedom, but really generational wealth, right? So not just for me, but also for my children and hopefully their children as well.
Amazing. I love that. Do you have any kind of outlets to connect with folks who, let's say, are in their 20s or even in their 30s to testify to how powerful real estate was for you?
I knock out about at least one podcast like this, per week with different people that I look up to in the real estate space. One of my own personal goals is to help at least 1,000 people become financially free through real estate, and also to create direct value for at least 10 million people. And so, I love giving back. One of my all-time favorite quotes is from Zig Ziglar, and he says, "You can have everything you want in life if you help enough other people get what they want." I did launch a website, daveallred.com, about a month ago, and it has a lot of my podcasts, blog posts, newsletters. I have a template in there called lifestyle design, which is something I'm really proud of. I've worked on it for 15 years, and it's the 10 areas of my life that I want to be great at, finances, health, family, time, spiritual experiences, relationships, personal growth, etc. And I basically have written down everything that I want to accomplish in those different categories to live a life with purpose and intentionality and with no regrets. And so I've actually added that template to the website, and it's a free download. If anybody wants to jump on there and check that out. I even made a youth version of that real quick.
Come
This
on, this is
summer.
great.
Yeah. Yeah. So I've got these 4 beautiful kids, right? Ages 8, 11, 14, and 17. And so, my lifestyle design has given me so much kind of purpose and direction in my own life. And so I kind of watered it down a little bit into a youth version. And so this summer I spent, a few hundred hours with my kids going through that and helping them identify, how they would envision the best version of themselves in each one of those 10 areas. And so that's a downloadable copy as well on my website, which is, free for anybody that wants to. If that feels like they get value from that, feel free to jump on there and it's a free. Anyway, it's trying to create value for people.
I'm definitely going to take advantage of that. I have 3 kids as well, younger. So I don't know if I have a couple hundred hours like you just said you did, but it's probably worth it, right? You think about passive income and generational legacy. It's what we invest now.
I would say, to me, I feel like the best thing I can do as a father is if I can help my children to see the best version of themselves and to internalize that and even have it in writing in those 10 different areas in their life. I mean, that's about the best you can do as a father, as a parent, because when they go off to college and, they go and do their own thing, they're going to make their own decisions. But if I can help them envision what that looks like to create happiness and fulfillment and a life lived with purpose and without regret. I mean, ultimately, I think anyway, it's just been a really fun process for me to build that with my family.
For you to even state that though, as well as, I think about you having 1,000 doors, but helping 1,000 people become financially free it's so significant. So I think both sides of that equation are so powerful as you train your kids, as we train our kids,
Well, speaking of children and helping them, another thing that's been really fun for me is to hire all of my children as my employees of my own, real estate company. And so they're all employees. And, if any of my children walked in right now and I said, hey, what's the best type of income? They would all say passive income. Like we really ingrained that for them. And, they're all very competitive with each other and who's, got the most passive income. And, my daughter's got, she's done a JV joint venture partnership with me on some real estate and, owns a duplex right now. And in fact, she wanted quick story. She wanted a Tesla Model 3 really bad for her birthday, right? Last year. And I'm like, no, there's no way we're going to do that.
Is this your 17-year-old?
Yes.
Okay.
Yeah. And I'm like, no, we're not gonna do that. That's completely irresponsible. Right. But after 2 weeks of her just continuing to push for it, which by the way, it's a double-edged sword when you teach your children to be good salespeople, right? Because no means yes all of a sudden.
To overcome the no's, the rejection, 100 a day.
Yeah, just relentless, right? And so, but I kind of stepped back and I thought about it, and the higher quality question for my daughter would be, all right, so this is a depreciating asset that you want. So how can you create enough passive income to pay for the cost of this luxury depreciating asset? And so I went back to her and said, okay, so it's gonna be $350 a month. So if you want to sell off some of your stock portfolio and some of the cryptocurrency that you bought, when you were 14, it's appreciated a lot, and then move that into a duplex with me. That's going to create $300 of recurring cash flow. And then, you can help mom kind of Uber the kids around with your new vehicle, and I'll pay you, X amount of dollars per hour. So she's now making, $400 a month, relatively passively, still protecting her nest egg in the real estate's appreciating. And now she has the car that she really wanted. Right. And so that's really beautiful because it's teaching, the kids like, hey, you can have whatever you want, but the right way, the mindset is, how can I create the passive income to be able to afford these items? So,
man, that is such a good story. I love that. Keep going. This is so good. So I want to hear about your fund. We can feel free to talk about lifestyle and family at any juncture, but I want to make sure I hear about how you transition from syndicating into a fund.
Sure. So I did about a dozen syndications, multifamily development. One of them was actually helping bring a Topgolf entertainment facility into Utah as well. That was a really fun one. But, I'm really proud of the fact that I can say out of the 400 plus, investors that I have, the investor capital with me, I've never once lost $1 of investor capital in any real estate deal. And, I'm proud of that reputation, and I wanted to make sure I can continue to say that. And so in 2020, I'd been investing into a few different real estate funds, and I really fell in love with the fund model because of the fact that it has a lower risk profile. And specifically because instead of investing in one address as a syndicator, I could invest into multiple different real estate assets into one portfolio. And that effectively mitigates a lot of the downside risk. And so what we do is, so that was one of the big benefits, is risk mitigation. The second big benefit is, the market's been so competitive where a lot of times you go into a bidding war on, say, a multifamily deal, and there's, 10, 20. I mean, we had a deal in Atlanta with 62 offers coming in on it. And when we can come in and say, hey, we're a fund, we're already fully capitalized, it gives you a real advantage in a very competitive, negotiating situation. Also, as a syndicator, one of the most stressful parts is you find the deal, go under contract, and then you have to go out and find the capital, right? And you only have maybe a 30 to 90-day window to do so. Whereas in a fund, you're fully capitalized. So it just makes that, that hunting process or that acquisition process a little bit more, not only enjoyable, but more competitive. And then the other thing is, usually in a syndication, I can only bring in, 10 to 25 of my friends. In a fund, I can bring in, up to 999 investors. And so I can create a lot more value for a lot more people through the fund structure. So those are probably the main reasons why I decided to switch from being a full-time syndicator into a full-time fund manager. And so it's been a really fun process. But again, I love syndicating. And some of my investors actually did like knowing what the underlying asset was in a syndication versus in a fund where you're really more investing, you're investing in the investment thesis and more of the jockey versus the horse, right? Mm-hmm. And so, but it's been really a beautiful process. And, to me, one of my goals in life is to always do bigger deals than yesterday. And so whether that was going from townhomes to fourplexes to a 20plex to a, 120 units to 400 unit deals, and then going to syndications, and then going to the fund model, I just found that if you're always doing bigger deals than yesterday, you're going to have that personal development, that forward progression, becoming the best version of yourself, working around other people doing big things. So you have that proximity, which has been really fun for me. And so that's kind of the overall kind of the mindset, I guess, behind the transition into the fund world. And one more thing to share is, when I do a syndication, it was, just multifamily or just, inline development or whatever else, self-storage. With our fund, our whole approach is recession-resilient real estate. And so we're able to go out and acquire industrial warehouse, which is projected to be the top performing asset within real estate in the next 5 years. Self-storage, which historically has been the most recession resilient asset. And then multifamily apartments, which is, bread and butter. I love multifamily. And so with our fund, we're able to go out and acquire all three of those asset types. And so an investor comes in and they get a, real pro rata equity position in all three of those different asset types. So not only do we get diversification, but it's also asset diversification as well as geographical diversification across multiple states. And so, again, our whole approach is simply, no matter what, we don't want to lose money. And so we really strive to find asymmetrical risk return, meaning that we can mitigate the downside risk of loss, but still create strong yield for our partners. So it's been fun. It's actually been really, really fun. And again, you can probably tell I'm very passionate about real estate. This is something that it's been awesome. I'm really grateful for having learned about this and being exposed to this, earlier on in life.
Yeah, I can tell that you're having fun. It's coming loud and clear, it's so engaging in conversation. I think it would be really interesting for you to break down some of the details. I think a lot of our listeners are accustomed to how a syndication works, when your distributions might start, how those things work. Can you just kind of break down for us, if you invest in a fund, what that looks like? Do you start accruing interest right when you invest? How much capital is sitting in the fund for you to deploy to have the competitive advantage against the other bidders? And then, like the overall word as you're talking is just, probably about you, Dave, but also your fund. Velocity is what I'm hearing, it's exciting to be around, but would love to hear a little bit more about, like if you talk with an investor, how does it work?
Sure. So I'll preface this by saying there's so many different ways of setting up a fund. And so they're not all the same. And really, it's one of the beautiful things about a fund is that you write the operating agreement, you kind of write the Bible that dictates exactly how the fund runs. And so you really can curate it very much to maybe your own investment thesis or your own, how you personally operate in real estate. And so the way we structured it is it's surprisingly similar to a syndication. The only So, for example, we're raising $40 million in equity right now. That will allow us to go out and acquire around $110 million of commercial real estate. So right now, we just take in subscription agreements, and that reserves space in the deal. There's actually no transfer of capital immediately. And then the way we've done our capital calls is we do one capital call per quarter. And so we spread those out, and the amount of the capital calls is dictated by the size of the deals that we're going to be closing on that quarter. And so, a lot of funds will call in the full 40 million up front, sit on a pile of capital. But to me, sometimes that could lead to being a little irresponsible with your due diligence, because you just want to get that money out to pasture. And so for us, we only call in the money that we actually need per quarter to deploy. And also because we're paying an 8% pref rate. And so as soon as that money comes in, then we're on the clock for paying an 8% coupon. And so that's how we raise the capital, how it comes in. And then we made an election.
Anything binding though? Let's say an investor says, I want to be in for this amount. How can you, as the operator, count on those funds being transferred when it comes time? I mean, that's
such a good question. And honestly, I was so nervous about that in our first fund. We had 157 investors come in our first fund, and I'm really proud to, and I was assuming maybe there's going to be maybe a 10 to 15% attrition rate there, and I'm so proud to be able to say we actually had zero attrition on that.
That's incredible.
I know. And on our second offering as well, and now we're on our third offering. And I'm actually surprised about this. We've had literally zero attrition throughout the first, 2.5 offerings that we provided here. And not to go on a tangent, but I do want to share this. I think that this might add a lot of value for your listener base. I would give credit to that to two things. One is that all of our investors are, it's really our friends, it's our family, it's our social network. I've never paid for an ad on Facebook or, any advertising. It's all just relationship capital. It's friends, right? And family. And secondly is we do something, I came up with this term 2 years ago, experiential investing. And if you go to our website, axiepartners.com, on the homepage in big font, experiential investing. And what that means is, instead of just making sure we get an ROI, return on investment, we're committed to an ROE, a return on experience and education. And so every month, we'll do a full webinar with the top guys in the industry, Joe Fairless, Dan Hanford, Neil Bawa. We'd love to have Whitney jump on with us. And they just teach and share value for 45 minutes, followed by 30 minutes of Q&A. Also, every time we close on a deal, we do a full webinar with all of our LPs, and we show how we found the deal, our underwriting model, full transparency, how we source the debt, our business model, all of it. And so it's really, it's creating value in a way that's very unique. I'm not aware of any other real estate funds that are so committed to that transparency and a value proposition of education. And what I found is, a lot of people want to be doing these type of big commercial real estate deals. They just don't know how to, they lack the confidence and or the competence to do it on their own. And so if we can actually teach and educate how to do what we do, it's been received very, very well. And so all that focus on value creation, I think, is why we've been able to have, such a sticky investor base.
Yeah. And it goes back to your philosophy that you shared earlier about, if I can, add value to other people, it's going to help me to achieve my goals. I completely agree with you. And there's a sincerity, and I think people these days have really high BS meters, and your sincerity comes through. And I think, if there is genuinely a desire to help move the needle on people's understanding, it's mutually beneficial, because then you're empowering them with information. Then they feel more comfortable entering into the deals, understanding the terms that you're discussing, understanding the opportunities. So it's mutually beneficial. But I think that you're right. You're sincere in that desire. And it's crazy. It's kind of goes back to, it goes around, comes around,
100%. Right. And that's really what's been fun for me too, though, is, when you put the LP first, right? So no matter what, the investors come first, then what you end up doing is long-term is you get a lot more repeat investors. And repeat investors for me has really been maybe the kind of the secret sauce, if you will, right? Because it's just so much, it's not only is it easy, but it's actually fun, right? Where you've helped them win and they've had a good experience. There's been good investor communication where the experience leads to repeat investments, and it's more of a plug and play. I mean, I have a few friends where, over a dozen deals together, and it's literally like, okay, what's the next one? Okay, are you doing it? Cool. Your due diligence is all right. I'm in. And so, but going back to the question on the fund structure, so we raise the capital, we deploy it. You go out and buy $110 million of real estate. And what we do is we pay a pref rate, right? So we do 8% preferred return. We decided to give 100% of the tax benefits to our partners. And so we don't take any of the depreciation. So we actually have a lot of investors that come in, even more so for the tax benefits than for the cash flow or for the equity appreciation, which is interesting. But then we also decided to use what's called a European waterfall versus an American waterfall. And if basically what that means is just, again, the investors come first, meaning that on the waterfall, and so waterfall means on a disposition, as we wind down the fund, the prioritization of where the money goes. So first and foremost is the investor gets paid back 100% of their initial investment. Number two, highest priority is the 8% preferred return per year. So as an example, say somebody put in $1 million after a 5-year, fund, that's 40% on the pref rate. So the first 1.4 million would go to that LP first and foremost before the GPs can take any chips off the table. And then whatever that pool of profits is that's left over is then split 80-20, with 80% going to the GPs, 20% to LPs, and 20% to the GPs. And so to me, that just creates like a really strong alignment, right? And I'm not promoting our fund specifically. I'm just sharing this as an example. When I go and invest in funds, I want to make sure there's a really strong alignment of interest where the GPs only win or make money once they've actually done what they say they're going to do, right? Mm-hmm. So that alignment, I think, is very, very important. So we decided to use what's called the European waterfall, which again basically means that the investor has to get paid back first plus pref rates before we can take chips off the table. Even with fees. I mean, there's like the management fee, for example. But like for us, that's actually just pays for our employees, our office space, kind of keeps the lights on. And so it's not a profit center, of course. Gotcha. Okay. Wow. Anything European is better than American, in my opinion. You had me at European. Well, this is great. I would love to. Okay. So let's I have a couple more technical questions, and then we can talk about what your family work-life balance looks like and just the concept of lifestyle design. You talked about you have a lot of value add, and just going back to that, the tension point of being uncomfortable within that. This is something, that it is the rub of value add, is that there's a lot of equity to be had, but bringing investors along in the bumps in the road during a stabilization process can be an emotionally jarring journey for folks who aren't used to it. I think for operators, it's, all part of the blocking and tackling of a value add. But talk to me a little bit about the hold period and how you engage with your investor base in their experience with the value add and some of the tension that can lie in that kind of a deal. Yeah. So first off, as an example of the experiential investing commitment. So anytime we go out and we do a site visit, or we even go and look at a potential acquisition, we'll actually invite our LP base to come out with us. We don't pay for their travel, but they're welcome to come out and actually walk it with us, just so they can see how, again, they can, boots on the ground, see how we do what we do. But how many actually show up? I'm so curious. Honestly, not a lot. I think people appreciate just the opportunity to be there, is there, but, very rarely, because it's usually, 2 to 3 days with travel and whatnot as well, getting out there. So, but maybe, it really depends too on geographically where we're headed to and whatnot, but so not a lot, but again, I think it's just appreciated that it's there. But then also we have a, monthly newsletter and quarterly reporting, and we have a lot of the videos or pictures of the site visits. So they can actually kind of feel like they were there. But, value add, I think that expression's been, I don't want to say kind of played out, but it's such a common expression inside of, especially multifamily over the last, probably decade, especially the last 5 years. And so our approach to value add is, yes, it's the traditional, new granite countertops, new paint, kind of lipstick on the pig, if you will, but it's a lot more innovative as well. And we found a lot of success with, again, creating these experiences, not only for our investors, but also for the communities. And so, putting in dog parks, or we call them dog spas. It's kind of the same thing, but, like shared office space, almost like WeWork in the multifamily assets has been really well received. Search engine optimization. I've been surprised how many of these assets have zero presence on social media. And nowadays, a lot of people do business through social media. And so we always create an actual online presence, not just with rebranding through websites and, rebranding the actual property, but also in social media. And that's been a very unique kind of a approach to value add. So it's just more of it's all the older stuff, but it's also a little more of an innovative, updated approach to value add. And when we look at what markets we go into, I think that this is so important right now, especially with where, the economy and the housing market is and is headed. We really love going into, I'd say our number one factor we really look for and we focus on is positive net migration. And so, as Wayne Gretzky says, it's not about where the puck is, it's where the puck's going. And so if we can figure out where people are moving in, there's always going to be that, a higher demand. And so we love Texas. We love Florida. We love Tennessee, Georgia, the Carolinas, Missouri, Utah, Idaho, Arizona, Nevada. So those are probably our top 10 markets right now. One thing that's interesting on that too is, they happen to be all red states, and it's not a political thing. It's just, the idea of eviction moratoriums and rent control and some of that stuff really scares us because we can't control that, right? And that really can have a negative effect on our pro formas and our targeted returns for our investors. And so we really try to stay more in the, landlord-friendly states as well.
Makes sense. And you mix the different asset classes within the fund. So you'll have all the different ones that you mentioned in the same fund.
We do.
Nice. I like that.
Which is an interesting value proposition for those that maybe are kind of just getting started in real estate, or they maybe have limited resources where they're not able to go out and put, $250,000 investment into an industrial park, or into fund or a multifamily fund and a self-storage fund, but to be able to get real exposure, direct exposure to all three of those recession resilient asset classes. I think that's why, this investment thesis has been received so well, and just the timing. I mean, I'll just take 1 minute on this, but I'm so excited about where I believe that the real estate market is right now and where it's headed. There's so much fear and uncertainty right now, and there's so many people talking about how scary it is. But to me, I mean, that's where real opportunity is created, right? It's when there is distress, and you can be opportunistic and be aggressive and go take advantage of those opportunities. I think there's actually a really interesting slide that I was just covering two weeks ago, where it shows over the last 2 decades, the most successful real estate funds in the United States were those that were launched during an economic downturn, right? Because you're able to go and get those really incredible basis on those assets. And so anyway, we're very excited about that. I think that, having kind of positioned ourselves with a main focus on asymmetrical risk and recession resilient real estate is the timing couldn't be better on it. And I think that's good advice for anybody that's looking to really, either get into real estate or even double down on real estate, is no matter what, make sure you don't lose. Like, when you lose, it literally is 1 step forward, 2 steps backwards. And Warren Buffett says it the best. He says, rule number 1 in investing, don't lose your money. Rule number 2, don't forget rule number 1.
Well, Dan, thank you so much for joining us. It was a pleasure to recently meet you in person in Salt Lake City, and I'm grateful that you're going to join us here on our show today. Thanks for being here. And not everybody who's in the passive investing space has the benefit of being a CFO. So let's talk about what skills and competencies that you have found to be valuable in real estate investing and that can be transferable for folks, let's say, who might not be in your professional background with the level of experience in financial matters as you have.
Well, I would say that I'm very comfortable, right, diving into numbers and spreadsheets and underwriting, right, kind of validating projections that these groups are putting out. And I've been known to ask a certain number of questions about it. And if I can get a hold of their underwriting, then I can kind of pick it apart and do my own sensitivity analysis. So part of it's the numbers, part of it's the credibility of the story in the market and what their business plan is, right? So it's a combination of those things. But I think also the financial analysis piece I'm very comfortable with, but also having my own real estate, right? This wasn't my first time investing in real estate. So I kind of understood the dynamics, the importance of property management, kind of how things worked behind the scenes, right? How you manage assets effectively. So I think it was less of a, I guess, stretch to get into, this because I'd already been involved in real estate on my own. So I kind of understood the fundamentals of it, right? If that makes sense.
So when you're looking at, let's say someone sends you their underwriting, give me an example, if you can think of one where a red flag pops up in your mind and you're like, no way. What are the kind of things that give you the most pause?
Well, certainly if the expected rental increases are too high, that'd be a question mark, right? How are they supporting that, right? You don't want to be too aggressive in that. Of course, there has been very high rent increases in reality for the last few years, but I don't think people really expect that to continue. That was kind of an anomaly. With inflation, you would expect some. But so anyway, a rental increase that's too high, right? It's assumed, or comps. If you're looking at comps, and there's some of the comps maybe aren't the same asset type, maybe they're better assets. So that inflates what they hope to gain in rent. Certainly an exit cap assumption, right, is a key one that I look at. And that has to be kind of defensible, right? I can't give you a certain number of what's good or bad, but you typically want an exit cap that's expanded from where you're currently at. And, that it's reasonable to think in 5 years, what's a conservative exit cap? You want anything too aggressive because that may not be where the market's at when you're ready to sell, right? So is it going to be seller's market or buyer's market? So exit cap rates, probably one of the biggest ones that can easily swing numbers in one direction, right? In terms of projected returns. There's also vacancy and various other things that you would want to make sure assumptions aren't too aggressive.
And since you have a lot of background in market analysis, how closely would you align those numbers with the specific market? Let's just say rent increase, for example. How dependent on the market is that number? Or would you say it should be more across the board?
I think there's a component of that that's market driven for sure. And there's a component that's, the business plan. If you're significantly adding value, right, and improving units, you're going to see a rent bump, right? So it's a matter of buying into what they're planning to do. But also looking at the median incomes of the area, right? If you're planning to raise rent 20%, but the median income in that area and the demographics wouldn't necessarily support that, because again, you got to look at the income to rent ratio that people can afford, then that would be a red flag too, right? So you got to look at what are people going to be able to afford within that submarket, right?
Yeah. Okay, good. You mentioned before your fundamental belief in diversification, and whether it's with operators, whether it's asset class. Can you talk to us a little bit about your general investing philosophy? As you've grown, you've entered into single family, you've moved into multifamily. Talk to us about your investing philosophy.
Sure. And I think this is important also from the standpoint of, there's a lot of offerings out there for sure. When you look at syndications, there's different asset classes, and there's different A, B, and C, and then there's self-storage, and housing, and office, and everything else. So there's a lot of options out there. So I think it's important for any investor to kind of hone in on something and kind of get comfortable with something that they want to go after, right? So for my own philosophy, I'm kind of more of a value investor, let's say. And this kind of crosses over into kind of the equity markets, right? You got value stocks and you got growth stocks, right? And, I'm a follower of like Warren Buffett's philosophy. He likes to invest in businesses that make money, right? And they're not as speculative. So I'm the same way. I don't want to invest in too much that's speculative. I'd rather invest in something that's produces profit, or can certainly produce profit in the near future, and it's got intrinsic value to it. So I think for me, real estate has kind of fit right into that kind of mindset. So just going back to equity markets again, I do still invest in the equity markets, but I've certainly shifted a lot of my portfolio from equities to real estate. But when I'm looking at things in the stock market, so I pay attention to some of the fundamentals like PE ratio, right? Price per earnings ratio, which kind of shows what something is valued at against their earnings, right? And that's similar to a cap rate dynamic, right, in real estate. So my point being here is that maybe an example I could cite would be, Tesla right now, they have a PE ratio of 55, which is a very high PE ratio, which means the company's market value is really high compared to its earnings versus a Ford or a GM, and their PE ratios are probably around 5 or 10, right? So I'd be more likely to invest right now in Ford and GM than I would Tesla. And that's not to knock Tesla. It's a great company. They're a pioneer. They've made a lot of money for people. But if I were to think about where to put my money today, it would be Tesla. It would be Ford or GM, right? Just because of, I think there's a lot more downside than upside, right? And so like last year, for instance, I had a lot of money in Buffett's Berkshire Hathaway, right? And so last year, 2022, that stock went up 4%, I think, while the S&P and the NASDAQ both went down 20 to 30%, right? So that just validates for me that if you're in kind of more value-oriented investments, you're probably less likely to see all the fluctuations, all volatility. That's a lot of reasons why I moved some of the money out of the stock market. It's very volatile. You don't feel like you're in control. I think that there's other value type investments outside equities that make sense, like real estate. So I'm more of a value investor, and I don't need home runs necessarily. They're nice if you get them, but I'm okay with singles and doubles, right? Base hits. And I don't need to double my money in 2 years. I'm fine doubling my money in 5 years. And that's what a typical real estate investment that's solid ought to maybe potentially produce, right? And I'm okay with that. You got to have some. So I have a little more patience. I'm not looking for the kind of immediate, home run. Mm-hmm. And so I've shied away from, so again, I guess my philosophy is rather value oriented. And I think real estate kind of sits in very well with that. I think the other thing is to kind of resist kind of shiny object syndrome, right? Because there's a lot of noise out there. There's a lot of alternative investments, and even more that has kind of crept up over the last few years, right? I mean, you got crypto, you got NFTs, you got SPACs, you got Robinhood, the ability to day trade based on Reddit memes and all these different things, right? And I think a lot of people hope to kind of make a lot of money very quickly overnight. But to me, that's more gambling and that's more speculation, and that's not true investing. So I tend to shy away from that and kind of focus more on more boring investments like real estate. And boring could be a good thing. And again, I'm not knocking anybody else's strategy, but I think as an investor, it's important to kind of like find your lane, kind of stay within it, see what you're comfortable with. So I'm a little bit more conservative, I think, by nature. I'm willing to let time, kind of like play out. And I don't need this kind of immediate life-changing thing because it's oftentimes not going to be there. It might be a mirage, right? And so I think kind of picking what you're comfortable with based on your philosophy, and mine is more value-oriented in real estate, I think sits very well into that. I'm willing to take time and to hold investments over a longer period of time. And I think over the long haul, real estate's proven to be a pretty good investment, right?
Mm-hmm. Yeah. So you got into multifamily, you said in 2019, is that correct?
Yeah, in terms of syndications, yes. Mm-hmm.
Okay. What have you perceived as a lot has changed in the last 6 to 12 months from where we've been per your Goldilocks comment. What are some of the biggest changes that you've seen with the different operators who you're in communication with?
Well, certainly there hasn't been as much deal flow, and it makes sense, right? It's been difficult to find deals that make sense to buy given the high debt costs. And I think the seller and buyer expectations have been kind of in different places. There's been this gap. And I've gotten a little more active myself in syndication. So with my partners, I've been looking at deals, and it's been clearly the case that there hasn't been a lot of deals that make a whole lot of sense. I don't want to stretch the numbers too much to be too optimistic. So we've held off on a number of deals that just didn't make sense. So I think that's one of the clear dynamics, right? That it's harder to find deals. I mean, a seller wouldn't necessarily want to sell now because it's a down market, unless they had to sell, maybe, or you needed to, free up their money or something. So there hasn't been nearly as many deals out there, and it's been a lot more difficult with the current debt rates, right, to make things pencil out, and especially to get cash flow, right?
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.